Video, we'll discuss the major characteristics of a corporation. A corporation is a business organized as a separate legal entity under state law, having ownership divided into transferable shares of stock. A number of characteristics distinguish a corporation from sole proprietorships and partnerships. I will explain the most important of these characteristics, which are listed on this slide. The first 6 are advantages, whereas the last 3 are disadvantages. We will discuss each one in detail. As an entity separate and distinct from its owners, the corporation acts under its own name rather than in the name of the stockholders. Nike, for example, buys, owns, and sells property. Nike borrows money and enters into contracts in its own name. It also pays taxes as a separate entity. Since a corporation is a separate legal entity, creditors have recourse only to corporate assets. The liability of a stockholder is typically limited to their investment. Creditors have no legal claim on the personal assets of a stockholder unless fraud has occurred. Shares of stock represent ownership in a corporation. These shares are transferable units. Stockholders can dispose of part or all of their investment in a corporation simply by selling their stock. The same cannot be said for a partnership. The transfer of stock is entirely at the discretion of the stockholder, which does not require the approval of either the corporation or other stockholders. It is relatively easy for a corporation to obtain capital through the issuance of stock. Buying stock in a corporation is often attractive to an investor because a stockholder has limited liability and the shares of stock are easily transferable. The life of a corporation is stated in its charter, and most corporations elect a perpetual life. Since a corporation is a separate legal entity, its continuance is not affected by the withdrawal or death of a stockholder, employee, or officer. As a result, corporations have a continuous or perpetual life. The organizational structure of a corporation enables a company to hire professional managers to run the business, but the separation of ownership and management often reduces an owner's ability to actively manage the company. Stockholders legally own the corporation, but they manage it indirectly through a board of directors that they elect. The board of directors formulates the operating policies for the company. The board also selects officers, such as a president and 1 or more vice presidents, to execute policy and to perform daily management functions. As this chart shows, the CFO delegates responsibility to other managers, such as the controller and treasurer. A corporation is subject to numerous state and federal regulations. For example, state law usually prescribes the requirements for issuing stock. Publicly held corporations must disclose their financial information to the SEC through both quarterly and annual reports. Owners of proprietorships and partnerships report their share of earnings on their personal income tax returns, whereas corporations must pay both federal and state income taxes as a separate legal entity. In addition, stockholders are required to pay taxes on cash dividends. So many argue that corporate income is taxed twice, often referred to as double taxation, once at the corporate level and then again at the individual level.